Awesome. Well, Jude, welcome back, M&A Therapist. I guess this is episode 4. I was out last week, so Brenda filled in for me. I'm sure that'll be a good episode. But I think today what we wanted to talk about is things to do prior to a sale process to sell your business or set yourself up for success. So, I think one of the things you and I have talked about a lot, and I think you're dealing with it on one of your deals right now, is the importance of having a financial plan. So maybe we'll just jump off there and see where it takes us.
Yeah, that's great. Yeah. I mean, I'm happy to kick it off, right? So I think before a small business owner just, you know, thinks about selling, I think they need to look at themselves and be like, all right, am I ready to sell? And what do I need in terms of like a, you know, dollar amount wise to retire, right? What is your end goal terminal number, right? So figuring that out is, I think, number one before figuring out the valuation for your business. So yeah, one of the examples happening right now is the seller jumped into the process of selling the business without having a concrete plan into what they need to retire, right? What is that end after tax number you need to invest in and then live off the earnings instead of eating into the principal, right? So that was done during the process instead of at the beginning, right? And just for clarity, the seller found out that they actually need less just because of the assets and the incomes that they have of their other investments. So I think that's very important. Like, yeah, what do you have to say about having a personal finance plan, having a business plan to doing a transaction?
Yeah, I mean, I think one thing that we see all the time is it's really hard to put together a personal financial plan when you are continuing to run personal expenses through the business. That also complicates the business plan, right? And understanding what the value of the business is, because if you're, running personal expenses through the business, it's hard to understand how profitable actually is my business. And so I think that's really the first step, and it can take some time, right? I encourage everyone to start very early on the personal financial plan because sometimes you find out that you actually need more than you think. And in your case, I think we actually found out to the better, right? Needed less. I've had a deal fall apart in the past because the owner realized that he had his daughters going through very expensive college and needed additional cash flow for the next couple of years. And so it's important to start that process early to make sure you know exactly what you need and you can actually put a plan in place to figure out, yeah, what is the plan to walk away. Um, I think the other thing that came up on this topic with you is when you have business partners, right? And if both of them have different objectives or needs, it's important to understand that also, because just because one of the business partners has, what they need to retire, they're confident in the number, that doesn't mean that they're on the same page. And so, yeah, maybe talk a little bit about how, you got that financial planner involved and how they've been able to help work through some of those challenges.
Yeah, so the financial planner got involved, I would say, pre-LOI. So, because I was doing a pretty complex after-tax net proceeds analysis for the sellers, right? Because and I think it's quite important to do it. Obviously the headline number is not what you're taking home, right? You need to consider the headline number, the cash in the business, the debt in the business, transaction expenses, taxes, which can include federal, long-term gains, net investment tax, state taxes. So obviously you can see those ins and outs happening, and then what you start off with the headline number becomes very different to what you take home at sale, right? And it becomes even more different when you have structure in place, right? Not all cash at close, you have seller notes and equity rollover happening. So anyway, like put this pretty complex after-tax net proceeds analysis together to figure out, all right, what is the estimated number you are going to take home when all your assets are sold? Property, real estate, real estate and the business are sold. And then we noted that one of the partners, he might needed more, is what he told me, right? So I think, but when you dig a little bit deeper, there wasn't any basis behind that answer, right? Okay, I need X dollars to retire. Why? There's no proper answer that they can provide. So basically, I involved this personal finance individual that I've known since I was young, And and I think it's also important when picking this individual, if we are recommending that there's a that the business owner and the personal finance this RIA can mesh well together. And I think that was the first thing I looked for, is like, if I introduce this RIA to the sellers who are blue collar, very old school, like, would they be able to mesh together, and will personalities align, right? So since I figured that out first, I made the introduction, and it actually became very value added, because the RIA was going into more complex items, right? Like, how are bonds taxed? What's the investment allocations and going to look like? They built this ladder system with the bond, so that they can just live off the interest instead of eating into the principal, right? So anyway, like, when this analysis was put together, we figured out that one partner had more assets needed than what they needed, and the other was just about there, right? And the important thing about the second partner was that he actually didn't have any idea what he needed until the personal plan was put together. And I recommend, like, the plan should be put together at least 2 to 3 years before sale,
Mhm.
because if you're not there, you need a runway to fix it.
Right. No, I think that's absolutely right. And I think we see a lot of the times it's just fear, right? Because they haven't gone through the exercise of putting a plan together, and you're trying to make a really big decision, right? I mean, this is going to be the last income that you ever receive. You got to make sure that you have what you need. And I think a lot of people, they don't go through this planning exercise. And so when it comes time to make that big decision, they tense up and, maybe walk away, or all of a sudden the expectation for valuation changes because they feel like if they just had an extra 20% more, that would be enough. But I think what we're finding is a lot of the times, yeah, if you put the plan in place, you can probably get away with less than what you think.
It
Um,
is, yeah. I mean, it is quite complex too, right? And I think, like, if I'm sitting down, let's say I'm a small business owner and I didn't know about the financial realm, and I'm trying to put a plan into place together, there's a big knowledge gap that I would have.
mhm,
And if I'm sitting by myself at night trying to figure this out, and trying to make this end goal number correct, there's a lot of you know, s- uh, there's errors subject to happen, right? And that knowledge gap causes, like, paralysis and, like, moving forward, because they're like, oh, I don't know, like, oh, how do bonds work? How do bonds get taxed? How does the investment allocation matrix matter? So just that knowledge gap, yeah, is enough for the sellers to not to take the next step.
mhm. So let's maybe move to kind of the next part of this planning process, right? We talked a little bit about the personal financial plan, but now it's really the business financial plan. And the way I think about this is, let's say I know that the number I need to, be comfortable in retirement is $10 million, and I have $3 million in personal assets now. Well, that means that the business needs to fill the $7 million gap. So knowing that number of 7 million, it becomes much easier to put a plan in place for the business to figure out, okay, how do I sell this business for $7 million? And I think the first thing that we have to do to determine the value of the company is, of course, normalize the financials, right? And I think this is an area where it too can take multiple years to get sorted. Some businesses are in really good shape. They've done their accounting properly for a while. They don't run personal expenses through the business. That's great. There's usually still some cleanup that we need to do on the balance sheet, which we can talk about in a few minutes. But for those companies that don't have clean financials, they really need to start, a couple of years in advance. So maybe can you talk a little bit about some of the things that we would recommend to a seller if their books are in a messy state? What can they do leading up to a sale to ensure success?
Yeah, I mean, number one is you got to start running the personal expenses to the business, right? Because doing that itself, you actually don't know what you need post retirement, because the expenses are not coming out of your cash flow; it's coming out of the business's cash flow. And second order effects are that you actually don't know the true financial performance of the business, so you can't really strategize, make a plan to improve or continue investment, right? So that is, I think number one. Second is, I think, owner dependence. is another thing, right? Because I'm trying to hit these big buckets, right? Because like if the owner is involved in bookkeeping, selling, marketing, HR, like it's like the owner is the business. So and it's really hard to take the owner out of the business in day one. Sorry, like in a short amount of time. So that 3-year plan, you know, encompasses that as well. What other aspects are you thinking about?
Yeah, no, I think that's actually a great place to go, because yeah, dependence can be in a number of different areas, right? If, as you said, the owner is, heavily involved, still working 40, 50, 60 hours a week, and they're responsible for, managing customer relationships. They're still doing the bookkeeping. Those are areas that we want to try to hand off as much as we can. I don't think we'll ever be able to solve every issue, right? But we want to at least have some systems in place or some documentation in place to, pull that owner out of the business. I think the other thing that we see all the time, and people don't really think about it, is the owner's thinking about what their retirement plan is. But if you're like a lot of these, family-owned, founder-owned businesses that have been around for 40 years, chances are you have some key employees that have also been at the business for maybe 30 plus years, and they're thinking about retirement also. And so what we always see is there becomes this wave of people trying to leave all within a 1 or 2 year time period. And that can complicate a sale process as well. So I think, taking an honest look at the employee base, having those conversations with key employees early, it's really critical because everyone deserves to retire. And there is a plan that allows everyone to retire. But if we're not coordinating with all of those people, it can be, it can really put a wrench in the sale process.
Yeah. Just going back to point number one, right? Like with the financials, I mentioned that the personal expenses should be stopped. What other things can they do to really prep the business so that they can get through diligence? And, the buyers aren't looking for anything heroic, right? In terms of margins or EBITDA. They're looking for like sustainability over time. What can they do? What can the sellers do to, get the financials into a good place before the sale?
Yeah, I mean, I think there's a couple places we can go. Maybe I'll start with just the balance sheet, right? There's a lot of things that happen over decades, and when you're running the business, it's totally fine. It doesn't really impact the seller in any way. But when it comes time to sell, it can just create challenges or question marks. And challenges and question marks usually mean lower price or a structure that, um, you know, de-risks the deal. I think one area that we see with our industrial clients is really the inventory. You know, you might acquire inventory over 10, 20, 30 years, and no one's really keeping close track of it because it's in the warehouse somewhere, someone knows where it is, and there's always someone to buy it, right? But the question is, if someone hasn't bought it for 20 years, is it really good inventory, right? And so I think what I would encourage sellers to do is identify that inventory, have a real honest conversation with yourself of, is this going to sell for the market price in the next year, even though it hasn't for the last 20 years? And if not, well, maybe we can sell it for 20 cents on the dollar. And getting some value for that inventory is going to be beneficial to the seller rather than, holding on to it and then just letting the buyer write it off, because that's what they'll end up doing. I think we see the same thing with equipment, fixed assets. You might have some idled equipment that you haven't used in a number of years, but eh, if it's not necessary to generating cash flow today, it's probably best for you to take that off the books and sell it for, again, 20 cents on the dollar or even scrap it in some cases.
Because the buyer might do it and get the proceeds, right?
Exactly. So that's exactly right. So these are things that a buyer would say in a deal, I'm not giving you any credit for these things, but you're still going to. So when they're included, I'm going to immediately turn around and do all of those things and recoup some of my investment into this business, right? And so I think our view on it is, well, why wouldn't we just do that work up front and keep those proceeds for our sellers.
What about AR?
Yeah, AR is another good one. I think we see it all the time where um, all AR is collectible, right? Sometimes it just takes a little bit longer, and I think that's very, very normal. But having a good policy in place to say, okay, anything after 90 days or 180 days, whatever policy you decide is reasonable for your business, you should just take that as a write off, right? You can save a little bit on taxes. And in a sale process, it's going to be very hard to get credit for those anyways, unless there is a very specific story around that.
Yeah, and one thing I'll mention is also on the balance sheet, as we are talking about it, is customer deposits. Because right now, what we're seeing in the low middle market is the buyers treating that as a debt-like item, even though it's sitting on the balance sheet and it's not debt per se. But it is deferred revenue. They're treating it as like, hey, you owe us customer deposits because we have to fulfill the order post sale. So if you have 500,000 in customer deposits, they're asking for a dollar for dollar reduction in purchase price, right? So big material impact to the proceeds that the sellers will take home. So I think some work needs to be done to really identify what customer deposits are outstanding, how long have they been outstanding for, and has cash already left the business. And what I mean by that is, let's say you take a customer deposit today and you use that money to buy inventory. That money is no longer in your checking account, and then the advisory firm or the seller can make an argument with the buyer in terms in good faith negotiation to be like, hey, we cannot include the customer deposit that has already been used to buy purchase inventory. Right now, if you don't have the documentation, it's really hard to make that counter argument, and the buyers is going to say, hey, we actually need all this dollar for dollar. You have no documentation to prove that the money actually left the bank account to buy the inventory.
That's a really great point. I want to double click on it because yeah, in practice, I mean, what does that look like in a $10 million deal? And you're saying these customer deposits are going to be considered debt like. I mean, how does that impact the seller? And maybe you can also talk about uh, some of the data that you've seen with clients and how they're tracking these customer deposits.
Yeah, if it's a $10 million deal, right? The headline price is $10 million, and let's say there's no other adjustment. You're getting $10 million up front today, all cash at close. But there's a clause in the purchase agreement saying you have to leave back all customer deposits for the buyer, and they're going to be treated as debt-like. Now, what that means is actually, yeah, the headline price is $10 million on paper, but when you do all the adjustments at closing, pay your M&A advisors, take the cash from the bank. And there's going to be a line in the closing agreement saying negative $500,000. So that money is actually going to be left behind for the new incoming buyer, and you are now down 500,000. That's actually like 5% of your purchase price is gone, and you're actually paying taxes on the 10 million. Right. So if you don't have the proper documentation to back it up, like, it's always a negotiation, right? So you can always negotiate this down in your favor if you have the documentation. Problem is, the documentation is not the best from what I have seen at this end of the market. I've seen that the balances are tracked within QuickBooks, but they are very messy in a way, which means I cannot rely on the detail to figure out the exact balance, right? And that causes concern with the buyer, and it's hard to negotiate in good faith if I can tell the buyer, hey, these are the exact balances, and I have balances aging back 20 years, and the customer balance signage is positive and negative, right? So yeah, so the data is not the cleanest at this end of the market.
Yeah, well, and I always look over at your screen, and when you were doing this analysis, I saw just a massive spreadsheet, and yeah, you have old balances, stale balances from QuickBooks that were inputted 20 plus years ago. So of course, no one actually has any information or can remember why these entries were made. I think what we decided or discovered was that a lot of these were just plugs, right? They were making entries to make the headline number balance, but then all of the customer level deposits were actually wrong, or a lot of them were wrong. And so we couldn't rely on that data. And so, yeah, I mean, uh, the buyer in that case was taking the most pessimistic view of, oh, you received a customer deposit, and of course you're just putting that in your pocket and taking it home. Uh, and our point of view is like, well, no, we take those deposits and we buy inventory with them. We put vendor deposits down with them. So it's really important to, yeah, get this right because if you don't get it right, it's minus $500,000.
Yeah, exactly. And actually, sellers are not aware of this, like going into the process. So, I try to bring it up early as possible now because of the material impact it's going to have on their take home pay.
Mhm. Let's maybe shift gears a little bit. Let's talk about documentation. Um,
You love this topic.
it's one of my favorites, and you've got a couple deals going on right now. You're about to be in it with due diligence, but yeah, like from your experience, what areas of documentation? I think you're dealing with one right now with corporate documents and insurance. Like, help me understand what is the problem, and how could maybe the sellers have avoided this had they prepared a little bit sooner.
Yeah, well, for the most part, the buyer is going to have some sort of debt on the acquisition, right? It's not always their money they're bringing in. They have a lender financing it. So the lender is going to do their diligence and they're asking for all these docs to make sure the entity they're buying is legal and correct, right? So they're asking for all the bylaws and organizational documents and the stock agreements for all the owners, right? So if your entity was created, let's say 50 years ago, it's tough to the seller might not have those documents. They are also asking for EIN numbers. They're asking for the SS4, I believe, the form that you get when you create an EIN number. Now, I don't know if you have done that before, but the IRS website, when you go on there and sign up for EIN number, you just have one opportunity to get that piece of paper, and it's not emailed to you. You have to click a button to download the PDF. So if you didn't click that button, you clicked away at that time, you actually there's no way to get the form unless you go back to the IRS and request it, right? So it's that. Also, the lenders need insurance documents. So if you have workman's comp, liability, property insurance, vehicle insurance, those are all going to be needed. And uh, sometimes the seller actually doesn't know what insurance policies they have because it's handled by the office manager. The office manager is auto renewing this stuff, right? That was the one issue. The other one was employee bonuses, employee benefits, and just overall employee agreements related. And I'll leave that to you because I know you're going through that right now with one of your deals in terms of just HR.
Yeah, no, I mean it's really the full gamut, and it's funny because I think like anyone running a business, I experienced some of this myself, right? You're doing a million things, you're trying to push the business forward, and you're getting these emails, you're getting mail, and all of these documents are coming to you, and you don't know what to do with them, right? You save them down somewhere, never to be looked at again until they're needed. And when you go to sell a business, well, all of a sudden, every single document that you've ever had come across your desk is now needed. And it can be overwhelming to put all of this together. Some of the issues that we're running into or have run into on previous deals is, client changes their insurance broker. And so now they only have maybe 1 or 2 years of insurance policies and the loss runs for those policies. And so when you need to go back 5 years, well, now you're tracking down old brokers who maybe the relationship isn't even there anymore. So trying to find these documents. Employee benefits is always a tough one, right? You have other benefits brokers who handle this for you. The laundry list of what is asked for is quite long, and most people on both sides don't actually know what they are. They haven't seen them before. And so trying to communicate this and get the documents in a timely manner can be quite challenging and ultimately slow down a deal. So I encourage anyone thinking about doing this, selling in their business to, yeah, 2, 3, even 5 years ahead of a sale process, just start saving this stuff down because it will be asked for, and it's important that we can provide complete documentation.
Yeah, start early so you don't have to rush at the end, right? Just do it piecemeal by piecemeal. Every week you gather one piece of document, right? And then you put it into a file folder, data room, whatever. And I think that's yeah, it just takes the pressure off of the seller at the time of sale for sure, right? Because instead of getting 200 requests, now you have half of it already somewhere. So I agree with you.
Yeah, and it can be quite stressful. I mean, it's a list of, hundreds of documents, and some of the request items themselves will be 50 or 60 documents. I mean, um, take customer contracts, for example, or, we sold a distribution business and they had a lot of vendor contracts. Well, the business has been around for a long time. They've been doing business with these people for a very long time. And so we're looking for, something that may or may not have been signed 20 years ago. And it's relevant. It's relevant to the process, and you're going to be required to make certain representations and warranties in the purchase agreement. And those could be impacted by these agreements that we, don't know if they even exist. So it's important to just stay organized. Um, early on, and maintain that organization up until a sale process.
Yeah.
So, look, I think, we talked a lot about preparation. I think, why is preparation so important in my eyes? We can't predict the market for the next 10 years. We can't predict what a business is going to do for the next 10 years. And we can't predict what the seller's personal situation is going to be in the next 10 years. And so, being ready to sell the business should be a top priority. And being ready doesn't mean thinking about, oh, I want to do this sometime. Being ready means, engaging advisors that can help you put together that plan, engaging advisors that can help you put the documentation together, engaging advisors that are going to have a handle on the numbers and can put together the business plan and get you to that fantastic sale outcome. That process should start early. And the beauty of it is all of the things you need to do to sell a business can help you run a better business today and ultimately be a more profitable business. And so I encourage every seller, if they're thinking about this in the next 10 years, pick up the phone, start talking to people, and get a plan in place.
Yeah. That was very good insight. Pick up the phone, call Chris Weaver. He'll give you the rundown.
I love it. Well, Jude,
Oh,
this has been
Chris,
great.
pleasure.
Episode 4 in the
Episode 4.
books. I will see you next week.
Yes, sir. Thank you.